Joining us are Meghan Shue from Wilmington Trust and Degas Wright from Decatur Capital Management. Guys, welcome. Meghan, to start, for more than a year now, we've been talking about companies that overspent during the pandemic and are having to go through the painful but necessary process of cutting back. I mean, is America any different? Is maybe this debt ceiling wrangling short-term a problem for the market and long-term healthy?
Yeah, it absolutely could be a short-term negative. It's certainly a risk-off event. We definitely do not want to see the U.S. come close to any sort of a default, no matter how technical or short-term in nature it might be. The repercussions could be pretty catastrophic. We give an uncomfortably high probability to that happening, higher than we'd like, but still pretty low, about 10 to 20% maybe. I think what we are more likely to see is some sort of extension, even if Biden and McCarthy are saying that's not what they'd like to be doing, and then a relief rally. But then I think the market refocuses on the prospects for spending cuts, which gets to your maybe long-term healthy, but shorter term could exacerbate the recession that we already think is slated for the second half of this year.
And Degas, maybe that is the real issue with this debt ceiling fight, is it's adding another dose of instability and uncertainty potentially into a market where it could just be a straw that breaks the camel's back. So how would you be positioned right now as we approach mid-year?
Yeah, John, and going back to what Meghan just said, I think one of the things we have to look at is we may have a temporary default. What we're seeing in the Treasury market is that they're starting to price that in. If you look at the 1-month T-bill rate, you're seeing it about at 5.5%. At the 3-month, it's at 5.10. So this is actually a tactical way. If you're on the short end of the yield curve, you can actually get some additional yield as we go through this period. You know, I believe that we'll probably get very close to the cliff. If we go over with a temporary default, I think they're going to resolve it and we won't go into a permanent default.
Yeah, but Meghan, at the same time, SVB was just one bank, but it's really the aftershocks that are hitting the market harder than the one bank, right? So what should investors be prepared for and potential follow-on effects here, ripples through the market?
Well, I think there's the debt ceiling, and I think there's what's happening with the Fed. And the way I think about it is almost like when you turn on a shower as hot as you can make it, it takes a while for that water to heat up. And even though the Fed raised rates incredibly quickly, by about 500 basis points in a year, we're still waiting for that water to heat up and make its way into the economy. And even if the Fed doesn't go any further, we're probably going to see tightening happening in the form of banks pulling back. So that sort of trickle-on effect. And I think that the debt ceiling just adds one more thing that could be a risk aversion to investors when we're already expecting that tightening to be making its way into the economy.